All right. I think we're live. I've been accused of not starting on time in the past. Not today, my friends. 1 p.m. Today is, what is today? Wednesday, June 18th. Tomorrow is a holiday, Juneteenth, and a holiday day off. Don't want to upset anybody with that. And then Friday, we got OPEX. Z, hello to you. I think Friday will be the largest OPEX ever. And if you listen to someone like Goldman Sachs, they will tell you $6.8 trillion worth of notional value is set to expire, which I think is a dumb number, but that's how they like to measure it over there. I see a little bit less than that, but still the biggest expiration ever, less in terms of notional value expiring. So we'll cover that. Casey, if I'm your Lord and Savior, you're in trouble. But thank you for the... I'll try it. Any questions? If you put them in the chat, I think on YouTube, maybe even Twitter, I see them. We'll see what happens. But let us get into it today. Enough of looking at me. Let's bring up the old desktop. Let's set the stage. Set the stage. There's three dynamics to watch today in the markets. Number one, we have the good old FOMC at 2 o'clock. So we'll probably close this off by the time the FOMC is here. Lord help us all if Brent is still yapping away. So there's FOMC, there's OPEX, there's the Iran situation. So I guess there's going to be four dynamics. And then last but not least is our buddy Captain Condor. I want to start with Captain Condor because it's the easiest one to talk about. If you read our founder's notes today, you will see we covered these dynamics. We covered them yesterday. And why is this so interesting? Well, yesterday, again, if you're a SpotGamma subscriber, you know all about this. Yesterday, the Condor was struck at 59.80. 59.90, 59.85, and the upside was 50. Let me start over. All right, the Condor yesterday was at 60.60 to the upside and 59.90 to the downside. And what did we do? We rallied a little bit and then we dropped right to 59.85. Now, the market held at that level despite the fact that everyone was watching how many pizzas were being sold in the general area of the Pentagon. And so this is Condor over pizza indicator. And today we see that the Condor is all the way down here, 59.15, and then up at 60.35. So those are two big levels. You see them here as open interest and trace. If you don't know what trace is, trace updates the S&P market maker positioning throughout the day. And so you get this real-time signal of how market are positioned. And what you see here is there's a big positive gamma center mass here between the Condor strikes, right? Which infers that the market should have some stability in this general zone. And that stability is going to rub up against the Powell speech today at 2:30. And then any kind of flagrant Iran headline, Israel headline that comes across. And who knows if that Israel headline is going to be resolved this week, the Iran, or today rather, or someone backs off or whatever. But then we have obviously the Powell situation. So what does this mean? These are our price targets for today. And so if you look at, again, 60.35 there and then 59.15, I think we're going to tag one of those two levels today, triggered by Powell. Powell's going to come and he's going to say something good. He's going to say something bad. The market's going to take a good or bad, have a good or bad takeaway from that, and then we're going to move, right? And so what's interesting to me about this, if you look at it, S&P right now is right around 6,000. Actually, it's not right around 6,000, Brent. It is right at 6,000. And so I want to look up what the 0 DTE straddle is. I know there's only about 2 hours left in the day, but Powell's going to come up and he's going to say something. And the straddle right now is $31, $32, somewhere in there. So for my math, if we go up 30 points, we're going to hit that level, 35 points. And then to the downside, we obviously have quite a bit of space, right? So I think based on these targets and based on the fact that vol's either going to jump or it's going to contract, we're going to move possibly easily into that 60-35 area. Or if Powell's hawkish, then kind of down we go, and we could slide quite a bit farther than this general area. And this is just the 0 DTE space. If I unlock 0 DTE, you're going to see an extra position in here, and that is this 59.05. If you're not sick of hearing about the JP Morgan collar trade, then I suggest you take a vacation for the next 10 days because the JP Morgan collar trade is a massive amount of options contracts, roughly 35,000. That's billions of dollars in gamma. And that doesn't expire until 6/30. So if Powell's hawkish or if we get an escalation, let's all pray we don't get more escalation in the Middle East. Things cool off a little bit, but there's a little bit of an escalation. I think we're going to slide down and we're going to tag that level like tomorrow or Friday, right? Possibly even this afternoon if Powell really brings the wrecking ball. If we don't, right, let's say Powell's benign. I think the market lists today up in that 60-30 area, 60-35 area. And then we have the overhang of the Iran situation. If that turns out that, hey, maybe that's being de-escalated a little bit, you can see crude's down a touch, then we could rally sharper into Friday, right? Why is that? Because if you give people the opportunity to sell short-dated options, it's not really selling vol, but selling short-dated options, knowing that there's a holiday tomorrow, what are they going to do? They're going to take advantage of that, right? In this market, we all know that you want to sell options as fast as you can, always and forever. And there's never any penalty for that, right? Anyways, so the vol crunch, the holiday is a reason to think that the market could rally, and I think it could rally quite sharply. That 60-50 area, 6100 area to Friday makes sense to me. And then to the downside, if Powell's hawkish, I think there's more room to the downside here than maybe some people expect because of that Condor target, as well as that big JP Morgan support level. So I think for today, that kind of makes sense. And then generally speaking, I think we're going to hit 5905 either. If we don't do it this week and we rally into Friday, then I think we hit it or test it after OPEX. And the reason is because we'll build up a lot of momentum possibly into Friday. The harder we rally Friday, I think the more we could sell off next week. And so if we just kind of zoom out a little bit on our chart here, you can see here's the June OPEX for Friday. And then we have the JP Morgan position here at 5,900. That's going to expire somewhere around here. If you look at the last few expirations, you see here May VIX OPEX, we fell apart. This was VIX expiration. In the afternoon, we really rolled over. There was the Treasury auction that was bad, wasn't bad. Some debate about that, but the same day as VIX expiration, we really fell rather sharply. So VIX expiration is today. So we clear up some positioning there, but the positioning aspect is again a little dirty because of the Iran situation. Then obviously tomorrow, with the holiday, it I think incentivizes people to want to short vol or sell options over these next couple of days in advance of those holidays. And then if we just look back at April, you can see here again after April OPEX, we did loosen up and fall quite a bit. So OPEX day we spiked, and then that was sort of this catalyst to roll over a little bit. So we can get some pretty big moves after options expiration. And let's put some of this into context. So for those of you who don't know, we do a great video or series with the excess returns crews. You can find that on YouTube. Go to excess returns, search for them. You can find my OPEX Effect podcast, YouTube show. I don't know. Calling things shows feels weird, but that's what it is. So you can check that out. If you saw that, then you've seen these slides before, but I just want to show, this is what we look at the delta size. So we like to look at delta in expiration. Why does that matter? It's because when you look at the delta, you're seeing the options, the stock equivalent value of the options that are set to expire. If you use like the Goldman metric, that'll tell you about 6 trillion is expiring. They do a 13F style calculation, which is every single option that's going to expire on Friday has a 100 delta. Obviously not true. So when you look at this, what you see is, and this was taken yesterday, kind of before the Iran situation picked up a little bit, but you see a very heavy call skew, right? And if this call skew is in place, I think that means we will roll over and we'll give some back after options expiration. That was the view into May as well, and we had about a 2 or 3% correction after May OPEX. So for here, if we're above 6,000 into Friday, then I think we correct and we test that 5,900 towards some point between now and the end of the month. Do that JP Morgan position. And I think anything other than like nukes coming out, the market's going to be really well supported at that 5,900 level. And then we could see what sort of happens after that. And obviously, you can't play out Powell. Generally, my feeling is in FOMC, Powell doesn't really say much. Vol contracts a little bit, and then we just kind of move on with our lives, right? But every once in a while, like we had in December, obviously, Powell can say something that just gets everyone agitated, and we do a little bit of option selling. Yeah, tomorrow is the holiday. Yeah, and Kramer's saying, I mentioned the founder note 6,100 by Friday. I think that is still possible. The trick is the Iran situation, right? If we walk out of the day today feeling like that's not going to escalate tomorrow, then I think that is a great chance. Now, I don't know how we weigh that out. I think Trump's having lunch with I don't know if that matters, the Pakistan guy. Did they order pizza? How many pizzas did they order? That could be the sign that we all need. We will see. But I do think that if Powell's quiet, we get that 60-50, then obviously getting to 6,100 is going to be simple by the time of expiration. And if we look at the positioning here around 6,100, let's go to Equity Hub. And if you have not seen the new SpotGamma Equity Hub model, they've been out for a while now, since April. They're really great. You get a lot of really good information. And what we're doing here is we've been tracking the options positions as we see it for funds over the last year. We compile that across all exchanges, all products, and we give you what's called SpotGamma Synthetic Open Interest. So you see how customers, that's like hedge funds and retail, are positioned in all U.S. listed stocks. And so we could check some names everyone cares about, but this is the SPX. And so what do you notice here? We have 60-35, 60-40. This is the Condor. You can see how much gamma that is per strike. It's huge. Then you can see the clustering down here of the lower end of the Condor, as well as that JP Morgan position. So that's 29,000 contracts. The Condor today, very big position. And then what happens when you look up, you don't see a ton of positions, right? You see a bit at 6,150. There's just not much up there at 6,100. These positions have really decayed over the last couple of days. And if we add in this little feature and say, well, show me what gamma is minus the monthly expiration, you could see that we're going to lose only a little bit because that JP Morgan position doesn't expire until Friday. But look at the negative gamma that's lost to the upside, right? So there's a lot of upside calls that are going to go away, and that kind of detracts or removes some of the upside momentum that I think was in place in really into the last week, right? And so, you know, what we're really left with is this kind of, we've rallied sharply overall. I know we've given some back, but if you just zoom out, we've rallied really pretty sharply here over the last days and weeks and months. And, you know, so a little contraction here as a base case to the 1,500, I think makes sense because we don't see a lot of people positioned for sharp upside in the S&P at the moment. So I still think that certainly if Powell's quiet, that should rally us into the 60-35 area for today. And then, you know, you got to, again, try to assess that Iran situation. If that's quiet and we can short vol over this holiday and that vol can contract, then I think that adds for a little bit more of a bid into Friday. Let's take a quick look at the scanner tools to see what assets are doing well. So one of the interesting things about the Iran situation is it's unlocked correlation, or it's decreased equity correlation, I should say. And so what's interesting about this, and I want to just cover this quickly, is if you look at Core 1M measures the vol of the top 50 single stocks in the S&P 500 versus the implied vol of the index itself. And so what you see here is correlation is fairly high, right? It's at the highest point it's been this year. And if we zoom out even farther, what you'll see is correlation is basically where it was in 2021 and during 2022. We hit real correlation lows in 2024, and now we're kind of back to normal. What does this mean? Well, in 2024, everyone agreed that stocks were the asset to own, right? The AI tokens over everything, that whole conversation. Well, tokens over tariffs is a new thing, but you know, AI was the ruler, right? And which AI stock did we have to own to outpace everything else? We have to own NVIDIA, and we chased the individual stocks. There wasn't so much a discussion about asset class allocation, meaning maybe I should put some in bonds, or maybe I should put some in CDs, or maybe I should put some in real estate, or whatever. It didn't matter, right? It's like I got to own stocks, and then it's which stock should I own? That forces correlation to lows, and we broke 2017 lows in correlation of those metrics. So now with the onset of the tariff stuff, right, correlation has spiked higher, and what that is telling us essentially is there's now a conversation to be had about what assets do we own, right? Do we own stocks? Do we own bonds? Because if rates go down, maybe I want to, you know, play in the bond market instead of monkeying around with equity at all-time highs. And so you can see correlation has spiked up. And what's interesting about that is we go to the scanner tool. This is IV rank on the y-axis, and then on the x-axis we have what we call risk reversal rank, which is essentially how much is put IV versus call IV. So to the left side, you have puts are more expensive than calls, and then on the right says calls. So oil, unsurprisingly, with the Middle East situation, oil is having extremely high risk reversal rank, specifically USO. Calls are very bid. All that makes sense. And then look at gold and silver here. They've been breaking out all year, having great price action. and the calls are starting to get bid. Now, the implied vol, I would argue, when implied vol gets to this top quadrant and you start to see IV ranks in the 75s, then you're starting to max out on that stock up, vol up situation. It's kind of a topping signal, right? So you can see those two assets are breaking out. They were breaking out before the Iran situation. The Iran situation maybe makes their bull case stronger. And then how does this all relate to correlation? I was just looking at, look at all the equity ETFs, right? All the equity ETFs are just piled down here. You see XLE is separating from the pack, understandably. Bitcoin is, and then, long bonds, which maybe now are a decent hedge given the macro backdrop or geopolitical backdrop. But equities are really highly correlated down here. So puts are more expensive than calls, but vol overall is not that high. So what does this tell me? Buying calls makes sense in this type of environment in equity space, but also buying puts or put spreads is also a reasonable base case here because implied vol is not all that expensive. So long optionality here to me makes a ton of sense in the equity space, and I don't know that it matters which sector you're looking at necessarily. At least maybe to the downside, because you can see spiders is essentially having the same ranks as everything else. We've made the case over the last week that you wanted to own SMH because SMH could rally a little bit more than the single stock spiders case. Mainly because SMH doesn't have to deal with that positive gamma that may be kind of holding us in around 6,000. And so SMH could lead. I think SMH still makes sense out of this because AI is still going to be our savior, I think, if the market, really breaks higher. So, those calls are pretty cheap. So when I'm expressing the views here, like, hey, we could move down to 5,900 next week in the SPX, or maybe we'll hit 6,100, on Friday. I think options are a very cheap way to play those moves right now. They can offer some excellent risk reward, I believe, as we look at it. And then we can break this down to the single stock space too. Even though correlation in single stocks is high, there are some interesting movers. So you can see there's some names here that are breaking away from the pack. The other interesting one is CoreWeave. Very high risk reversal in IV rank. And what's interesting about that is the stock has a very high, other way around, Brent. Look at that stock. It's been ripping, right? So the fact that put vol is so high with the stock ripping is really, really interesting. People are really betting on this thing crashing, and you have the stock up, put vol up situation, which is pretty bizarre. So if this stock starts to come down, you may see put vol actually contract, right? Because that implied vol does seem high. So that is one particularly interesting single stock that comes up on the scanner for those of you looking for a couple of interesting things to play. Last but not least, on my little 20-minute rant here, let's look at fixed strike vol. Why do I like fixed strike vol so much, and I look at it so much more than the VIX or other vol indicators? Is because the VIX is an indexified measure of volatility. It is susceptible to S&P skew, right? So higher strike options in the S&P 500, if we just look at skew, they naturally have lower implied vol than put options or downside options. So what does that mean? Well, if all of the options in your calculation are, say, right here with a 27% implied vol, in the market rallies 2-3%, well, now most of the options in your calculation are now 16% implied vol. So the VIX naturally goes down. That doesn't actually tell you what's going on under the surface. And so when you look at fixed strike vol and you say, okay, last night we went into the close concerned about the Iran war. How is it looking today, even though we have Powell? Well, you can see today's vols are very jacked. Makes sense. Well, look at vol for the rest of the basically time going forward, right? It's down across the board. And this is comparing from last night's 3:45 time to right now, live. And if you just look down, the vols are down across the board, right? So the Iran situation has largely, according to the options market voting system, right? Those vols are coming in. Oil's coming in a little bit, right? So we can see that there's some contraction here. For bulls, that's good. And if you're betting on, major downside due to the Iran situation, obviously that can change in a heartbeat, but the market seems to be cooling off from that. If Powell comes out and is quiet, then you would likely see VIX move under 19, I think, and then you'll see these longer dated vols move down towards, like this will probably be down more than 1%, et cetera. So you'll start to see that vol contract, I think, even more, again, particularly because we have the holiday tomorrow, and that should lift stocks. So that is why looking at vol is so important. If fixed strike vol is higher today than it was versus yesterday in particular, then you would say, okay, there's a lot of anxiety still around this Middle East situation, and so we should be wary of that. And then here's S&P term structure. You could see, we're at 16% implied vol out in time. This was around the high 14s, low 15s a couple days ago. So the Middle East situation has definitely added some vol premium in here. But again, I think right now, at least how it looks, is that Iran vol premium is coming down a little bit, and we'll see what Powell has to say. Who knows? Trump could finish his pizza with the president of Pakistan, and then things could change. I guess Trump likes McDonald's. Hopefully, he wouldn't give the president of Pakistan McDonald's. That'd be a little disrespectful. Yeah, a lot of stuff on. I see dot plots and the debt ceiling and different things like from Michael and Roulette, and I don't have anything to offer you all on that. There are unlimited macro mavens on X, so you can go and ask them what's going to happen. I think in the short term here, all that matters is, hey, are we going to get a cut or prospect of a cut? Because that is what equities want to hear about. And if that ever happens, then we go up. And quite frankly, even if we don't get a cut, then the markets may still go up. Right? We tend to buy dips. That seems to be what's happening here. And I was making this like joke about everything is there's like a deli down the road from my house. I live in a very rural area, and they sell iced coffee for $9. And I was like, someone else had said something about how is it possible the S&P is above 6,000. I'm like, well, if iced coffee costs $9, which is just retarded, then what? Then stock inflation dictates that maybe stocks are just worth that much too. And yes, you're going to throw PE and all this other stuff at me, but say la vie. Checking some questions. We'll look at Coinbase. And the BK show. All right. All quiet on the question front. We could take a quick look at the Coinbase situation. So what we're going to look at here when we go and look at Coinbase, we want to see where the positive and negative gamma pockets lie, and we're going to use that as a mode or method to forecast how much movement we would expect in the stock. So right now, Coinbase all the way up there, 292. It's been an incredible run. Stocks up 15% today. Really amazing. I'm guessing that's because of the passage of the Genius Act. Don't really know. So we're all the way up here, right? What is significant about that is that you can see the positive gamma in the stock for right now, right, for today into tomorrow is at this 565, 570 area. But look what happens after expiration. You're removing all of the positive gamma. So what is this actually? It looks like traders were short puts, short some calls, not huge, right? And then looks like one long call position here. So these two positions in particular are going to go away. And so what that tells me is that I think that the stock is well supported in this all the way down to 265. We're obviously way above that right now. But the gamma in the position or the gamma in the name is certainly likely to go away based on this. Certainly these 275 calls look like they're going away. And so when you're seeing this huge spike into OPEX, I think some mean reversion there may be on order. Of course, if Bitcoin goes crazy, you got to take that down, but that does seem a little bit too extended. The other one that I've been looking at heavily here is AMD. AMD up at this 130, 132 area has a ton of gamma into Friday's expiration. You can see a lot of that goes away and it gets actually negative to the upside. So how would I express this? Like counter spreads, for example, selling 130 calls this week or in that area and buying them for next week maybe would make sense, or just kind of betting on that we hit this resistance. Stock has faded a little bit here this afternoon, but we did test that area this morning. Stock's actually moving quite a bit sharply lower now. So you're going to lose this upside gamma that I think was resistance at 130. And then to the downside, there's a little bit of light positive gamma, not a ton at the 115-ish area, I would say. So if you're looking for a downside target, I think the 120 area for sure makes sense. Maybe as low as 115, but you can see this gamma based on the yellow line shows that could be where some major support is. So I would look at that. Matthew Kochuba is looking at USO. The problem with using the gamma positions in something like crude or gold or whatever it is that, the actual futures market is going to be so much bigger than the positioning in the single stock ETFs, right? So when we look at this in particular, we see the 82 strike is really big. and it's a huge call position. So the dealers are short a lot of puts, right? 40,000 puts. That's what we're showing you here. So there's a ton of negative gamma. This position obviously goes away with this Friday's expiration because that position collapses. So, okay, a lot of positive gamma. Oil's whipping all over because of the Iran situation anyway. So what do you take away from this? Well, if you're looking at TLT or gold or silver or even the IBIT, look at vols, right? Equity vols, because the equity vol for like a USO or for a gold has got to mimic the future. If it didn't, you would think that there would be a pretty good arbitrage there, right? And I don't know about the nuances of all the different commodity markets, so there could be some certain exceptions to that. But largely speaking, and this is a largely speaking difference, look at how oil is usually positioned here, right? This is the stat cone over the last 90 days. So typically, there's not much of a call skew in oil. If anything, there's a little bit of a put skew, right? Because you can tell by the stats widen out there. And in the call positions right now, if you look at like a 25 delta option that's a 100 strike USO call, it's trading at an implied vol of 80. That's wild, right? Because usually the 90th percentile over the last 90 days is a 43 implied vol. So that is very, very, very rich. Now it makes sense because if the situation there escalates, well, then you got a problem. So what are the ways that you could take advantage of this? I think, selling like some call flies can make sense. You maybe sell like an at the money and then 2 out of the money, so you can make that a delta neutral position. Don't sell naked calls, please. I mean, do what you feel is right. But there's so much garbage peddled on Twitter these days where it's like, fund your retirement by selling naked calls and naked puts and naked VIX options and stuff like that. Please don't do that. Odds are that the VIX does not go over 30 and that oil doesn't go over 100. I think, if anywhere we're playing just a roll of the dice, we would bet 9 times out of 10 it's going to happen. But if that one time happens, you lose everything, right? And so, that is just not a robust way. It's a fragile way to position in this types of situation. And the other thing with the USO is that the vol could remain elevated for some time if this situation doesn't really cool off. I think a lot of people don't expect it to last a whole long time, and let's hope it doesn't. But maybe this drags on for weeks and weeks, kind of like the Ukraine-Russia situation, right? And how much does that impact the price of oil? Maybe for longer than you expect. So if you want to short calls in this situation, I think that makes sense. Just set it up in defined risk structures. There's a lot of different ways you can do that. Just ask your neighbor local hood AI aid, and they can maybe offer you a few things. What's wrong with selling naked puts? Well, it depends on also what you're playing in, right? But what's wrong with selling naked puts is the stocks can go down farther and faster than you expect. And so a lot of people go, well, I just want to buy the stock if it goes down. I'd be happy to buy USO at 40 if I sold my put there and that's where it goes. Well, oil went negative, right, in 2023. And those situations are rare, right? But you can have a lifetime of put selling that's like great, and then you lose it all in an instant because you get a margin call and then everything is gone, right? And if you don't understand this, go look up optionsellers.com and you can get a great overview of when those things end badly. If you want to talk about short vol funds that all got taken to the woodshed in the Volmageddon or at the COVID crash, there's bodies littered with that kind of stuff. You can even go look at our friend in GameStop, right? Melvin Capital. They had fund shorting stock, which is kind of the same thing in a lot of ways. So 60-40 is possible for today, just to reiterate that. And, we're right between these two strikes. And kind of like yesterday, I mean, this is way down there, right? And so I think if Powell is not like super hawkish and forces that downside, then that vol gets sold and the market is, I really believe, going to rally into the 60-35 level. Some of you have read the Wall Street Journal article on Captain Condor. We did a ton of work on that article and brought that to them and everything. And so we kind of, really focused a lot on the positioning in that space. And one of the most interesting things in that Captain Condor is that when the size gets this big, talking 20,000+ contracts, the day after the Condor goes away, volatility tends to expand, which is really interesting. Now, the weird thing about this is obviously we're following an FOMC. We have the Iran situation. We have tomorrow as a holiday. So it's a little bit of a weirder situation than a normal, like a random Tuesday kind of thing. But there's the deal. And on the point of option selling, Captain Condor lost on 11,000 contracts yesterday. They doubled down, and then some today. So they have a 29,000 lot position. You're talking $4, $5, $6, $10 million now at a clip when these positions lose. So if they lose here, then they're pushing the 50,000 lot, right? And if they lose there, then they're going to push 100,000 lot. You're starting to talk about a lot of capital that you have to put up a $5 wide Condor. And so this is a martingale strategy in which when you lose, you double down, because are you likely to have 5, 6, 7, 8 losses in a row? No, but it's only a matter of time until you do. And anyone who's ever played craps or roulette knows, it's only a matter of time till you see that thing. You're like, wow, kind of surprising. But there we go. So works great until you don't. Yeah, and the problem is when you have skew like this, right? Selling the call spread isn't always like great, because what are you doing? Well, you're selling this option, which has a high implied vol. Great. But then what are you doing? You're buying one which also has a higher implied vol. So you want to be, you want to make sure you're aware of that when you're positioning in here. Now, yes, this option has a super high implied vol, but it's probably only worth a nickel. So you can sell something like the 25 delta, then just hedge it off with a nickel, something cheap, just something to protect yourself from complete ruin, right? So instead, it's only a stupid bad trade instead of a horrible trade. Again, odds are you'd make money on a short, shorting something that has an implied vol rank that's high. But yeah, if you go to the Wall Street Journal and you look up who Captain Condor is, they sell. So the interesting thing about that is the Condor man himself actually does a $10 wide spread, but then the big spread is $5 wide. And the belief is that is his trading room that seems to, or maybe his sister's got a giant PA and she's the one that does the $5 wide. I don't know. But the trades all link up. So we think they're driven by this guy. At least takes credit from it. And it seems to be his Discord room. So, is his Discord room the ones that are putting this stuff up? Well, the prints seem to happen in pretty chunky positions. So it could be he's just got a few, whales out there that follow him, the Pied Piper. I forget his name, and I don't want to mispronounce it. It's David Choi, something like that. Anyways, Wall Street Journal, Captain Condor. You can check that out. And for those of you who don't know, if you go to spotgamma.substack.com, we actually did a new study. And I should mention this. We looked at the impact of OPEX on realized vol. We've looked at price action before. If you want to read this, go to spotgamma.substack.com, and we post more stats around this. So what are you looking at here? So we measured we measured realized vol. So how much is the S&P 500 moving before options expiration versus after? And so what you see here is that when implied vol, I keep saying implied, sorry, when realized vol is low, so how much does the S&P 500 move? It tends to move less and less and less into an options expiration when we kind of have a low volatility situation, right? Which this was a low volatility situation next week. Obviously now we're moving a little bit more. And then what happens after expiration? Volatility, meaning how much the market moves, spikes. And this is the change in realized vol. So the week of OPEX, we lose 2 vol points and we gain 6 after options expiration. When you look at this across all expirations, that also holds true. I have high vol regimes as well, and high vol regimes do the opposite. So if the VIX is at like 30 into options expiration, vol continues to spike into OPEX and then it contracts after. So this is, in my view, some more kind of definitive proof that options expiration can be a real driver. And this is from 2020 to today, right? So this is evidence that options expiration can be a real driver. VIX expiration, that sort of window of weakness transition period, can be a real driver. Now, it's not window of weakness as the VIX is at 30 going into options expiration, right? You kind of get the opposite. But this could be interesting, right? We could have a vol spike today into Friday, and then we move to 5,900, and then vol contracts because all that game at the JP Morgan strike just kind of sucks the volatility out. So, David Chow, thank you, Chris Emery. So that is that's a really kind of interesting dynamic. A couple more Bitcoin questions. MicroStrategy is kind of an interesting one because there's such a MSTY is now the dividend ETF is just considered like the holy grail for a whole community. Talk about the Pied Piper strategy of following. But MicroStrategy is really kind of stuck, right? And you can see the gamma today very flat. So here I'm showing you the real-time deltas, excuse me. And it's very flat today, $23 million. It can do as much as $400 million of delta in a day. So this is nothing burger. And it's down a little bit, which is interesting because obviously you have Coinbase is up so much. And then Hood, I know there was a big insider buy yesterday. I saw a headline about that. It's up 3%, $86 million of deltas, which is pretty good. And the nice thing about this is that what you see here is there's some longer dated flow coming in. So the teal line is measuring just the delta for tomorrow or Friday rather. And when you see short dated options flow, it's like, okay, this is just a momentum trade likely to fade. But if you're seeing longer dated options come in, I think that's a pretty bullish signal. You can also see we have the call wall position up there. So that looks pretty good. And if you want to bet on a name that's really going to run, you want to see negative gamma above into next week. Hard to say you're going to get that. So what does Robinhood look like right now? Well, in this 80 area, you see a lot of positive gamma. So traders have sold calls. So this is a sticky point, I think, for Hood. And there's not much negative gamma for next week either. So as far as the momentum goes for the name here, it looks to me like it's pretty well stalled out in this generally 80 area. You can see these are all just positive gamma strikes, stocks right in this general area. So I would say this thing's stalled out, and you don't see a ton of negative gamma for next week. So, you know, what are you playing on, I guess, would be my question if you're holding the stock. I'm not saying if you're a long-term holder, you should sell it, but I'm assuming most people here have shorter-term high time horizons or are looking to trade something. So this doesn't strike me as a lot of, you know, uber bullishness to the upside. Let's check something like Tesla, which I know everybody likes to look at. You know, Tesla, you can see negative gamma after this expiration. So we're going to lose these short calls that are right here, this real high positive gamma node. And this thing has negative gamma to the upside after expiration. So that should have relatively more volatility, particularly upside after this options expiration as these short-dated short calls get cleared out. Steve B says, do I ever think to myself the financial media will say Fed soft, but it's really OPEX? I think about that kind of thing all the time. So if you think about the Treasury auction, again, on the Substack, we did a whole analysis of, you know, if you looked at the Treasury auction, the people in the fixed income market were like, this doesn't make any sense. Like the Treasury auction wasn't that bad. I'm not going to say they were correct or not because what do I know about Treasury auctions? But if you looked at the options positioning, it had just really released and lightened up so much, and it allowed for that volatility to kind of express itself, right? So the fact that Treasury auction mishap happens on equity response, right, happens on VIX expiration day after a very call-heavy options expiration, I mean, it's certainly a very strong coincidence. Now, correlation is not always causation, but you see this type of stuff happen all the time. The DeepSeek situation was another one, right, where there was such a response to the DeepSeek news in January, I remember, and everyone's like, oh, DeepSeek must be this big deal because the stock dropped 20%, NVIDIA, right? Biggest market cap off ever. And they're like, well, everybody's just levered. And so that makes the stock drop faster. Options expiration just happened. The Condor rolled off the day before, huge size. So there's the positioning that can exacerbate the stock movement. And then when you can see it through that lens, you go, okay, this is a little bit too much, right? It's a little bit too extreme. Again, on Substack, we did another analysis of Tesla 2 weeks ago around the Trump news, right? And we're like, this is way over the top crazy, the reaction, and it's driven by levered ETFs and all these other things, right? There's so much data that supports that supports that. It's the positioning now in single stocks which can really exacerbate movement. And then when people take the movement or the price action as their weighting mechanism to say this is how important the news is because this is how much the stock reacted, then they are misguided, right? At least in my view. So that can be a little bit wild and crazy, I should say. And let's just take a quick look because I know equity market just took a little dip here and we could see what we pick up on. So when we're looking at equity sell-offs, we want to look at a couple of things. Number one, What are the key levels around where we're trading? 6,000 is obviously the big metric. I'm only looking at 0DT positions here, but there's nothing else that stands out before the FOMC, which is not unusual with the exception of Captain Condor. So it's an open space right now, right, between those two strikes. So what are you looking at in terms of the options impact on the market? And we want to look at Hero. Why? Because every time someone buys a put or sells a call, that generates, in theory, some delta, and that delta is the hedging flow that may have to be covered, right, by market makers. Now, they don't hedge every contract. They may or may not hedge 0DTs in some space, but if you're getting $2, $3, $4 billion worth of deltas in like 15 to 20 minutes, someone probably has to sell some futures, right? Or if the rally's $4 billion, someone's probably got to buy some futures, right? So when you look at this in the little spike down the last few minutes, we went from negative 700 million in deltas all the way down to negative 1.6. So that was about $1 billion of negative deltas in about 15 minutes, right? And as soon as that selling stops, right, this purple line goes up. What do you see? The market stabilizes and rallies, right? Because the equity, the options trading flow backs off of that selling. So you could take that as a sentiment signal, or you could take it as actually, believing that these flows will push the market, which is what I believe. Either way, it's a great indication to help you navigate how this stuff is moving. So the S&P 500 indicator, again, is SPX, SPY, and the futures. And then the second component, which can be very large, is the S&P equity basket. So what's that? Every single stock in the S&P 500, we sum the deltas there. So Tesla, Apple, Coca-Cola, JP Morgan, blah, blah, blah. And what you see is that there's a very unusual spike right there. Sure, nothing's crazy going on there. So what do you see here? Huge buying this morning, right? Massive buying this morning until about 10:45. And then that purple line just levels off. People stopped buying calls when the S&P got to around 60-20. They just stopped. And then around 11:50, 12 o'clock, then they turned to sellers, and the equity market hasn't caught a bid again since, right? So watching this out of Powell, Powell's going to say something. Who knows what he'll say? Then all the macro people are going to be like, this is what this means. But what the macro people think it means doesn't matter. It's do people buy options after that, or do they sell options after that? Because they're putting their money where their mouth is. And what is vol doing, right? Is fixed strike vol going up or down after Powell completes his speech? If fixed strike vol comes down, then that suggests the equity market's going to rally, right? If people start buying NVIDIA, Tesla, Apple calls, then we're going to bet that the market's going to go up, right? So we don't have to guess about it. We don't have to try to read between the dot plots or anything like that. Let's just look at the flows, right? If people are buying calls and selling puts after FOMC and vol's coming in, well, then I'm going to really look for that upside 60, 50 to 6,100 target. And if it's negative, then you got to start eyeing that 5,900 level. And for today, that feels very extreme. That's 2% for today, so that does feel very, very extreme. But that 5,900 level matters into Friday and all the way through 6:30 as well. So I think you can structure some very cheap put flies, like a 5,900, 5,850, 5,800 put fly for Friday, for example, and bet basically nothing on that. Or structure something at 6:30 expiration, which is a put spread that's unlikely to have a lot of decay because it's still 10 days out and that JP Morgan position is there. So you can put on some pretty cheap positions that would hedge out that tail move, right? Because 2% in a day or two, would indeed be a tail move. But when we just look at the positioning, there's just nothing to stop, I would argue, the market really below there. There's just no levels of any importance, right, all the way down through here. Until we really get to that level. So it's a soft underbelly. And the difference would be imagine we're at 60-50. Well, you say, well, the huge position that could support the market's right here, right at 60-30. So am I going to bet on 2% if I believe that huge position will absorb downside? Well, no. So the fact that the positioning is there maybe makes that tail probably a little bit higher. Unless it happens, obviously, you can't really calculate the odds of it. So just something to watch there. I always watch Ghost is asking my hero time frame. I always keep it on 1 day. I just like to see the whole day worth of flow. Be careful if you're new to hero in particular, shortening the time frames, because it can create, it's a rolling window, right? So big trades roll out of the window and then people take a signal from that, right? Like, oh, hero's dropping, when all that's happened is big trades rolled out of your rolling window context. So just be aware of that. Chaz, you like the filters for synthetic OI chart. I'm glad you like that. in the equity market very quickly responded and rebounded from those big levels. Last but not least, before we roll off here in a couple of minutes, we have an OPEX spreadsheet. I forgot to mention this. If you go to spotgamma.com/OPEX, you can download that spreadsheet. It gives you all of the biggest positions for options expiration this week. Also, again, excess returns on YouTube. You can check that out. You can also go to substack.spotgamma.com. And if you want to try out any of these tools, it's a great time to try out these tools because there's so much happening in the options market over these next week. If you go to spotgamma.com, you can sign up for Alpha. That gets you Hero and Trace on all of our best tools. Gets you access to our Founders Notes. We do 2 Founders Notes a day. When you have the biggest expiration ever, you have VIX expiration today. You have the JP Morgan trade coming up in a week. You know, these options flows are really huge right now. And so it's a great time where you go, okay, I know if I try it out now, see what these people have to say now. Options market's huge, so it's a great chance for me to take advantage of this. Sometimes you sign up in like the middle of a boring month where not much options flows are happening, and maybe you'd argue you can't see the impact. But this time, right now, you'll see the impact, I think, very clearly. I always like to look at, this is called Tape. This is our time and sales tool. If any of you use time and sales tools with other people, there's a lot of annoyances in those other tools that we fixed. For example, you can sum order flow based on your filters very quickly. It's a great forensics tool. But I also like to go in here and see what the biggest trades are on the day. And the unusual volume here is indeed Coinbase. You rarely see it as the number 6. You always see Tesla and Nvidia at the top, right? But the fact that Coinbase is up at the top of this list is super interesting. Obviously, stock's up a ton today. So there's a real state change in what's happening there. Do you want to bet that this is going to continue? We did look at this before. So our synthetic open interest will update overnight. That will tell you whether people were buying or selling options into this news. And so, true to form of how we've been looking at stuff recently, we want to look at it minus next expiration. It makes total sense here that the stock probably dies out, I would think, because there's just no options positions anymore, right? They're just gone. There's nothing else there to drive the momentum in our view, right? Of those call positions. And then we look at Hero. What are people doing as the stock hit the 300 area? We got up to 290, and then the call buying has stopped. See that? The purple line is rolling over now. So that is really kind of maxed out. I think that 260, 265 area is huge support. And then lastly, let's just go look at vols. And you're going to see calls are probably fairly jacked. They're actually not that high, as you can see here, right? The call skew is elevated, but it's not like record. Or it's not even as high as if you're going to like an earnings. So when you look at selling like a 1 month 25 delta call, something like that in Coinbase, you're selling a pretty rich implied vol. Not like crazy, but it seems to be, pretty elevated. And so in this options expiration, I think selling like some short dated calls or something like that could make sense. Because that stock price has moved up so much. The vol isn't crazy, but I do just think that the momentum in that 300 level is probably stalling out some as we see in the positioning. And then last but not least, one more scan here, the old tape tool, see what we got. A lot of the usual culprits in here, I should say. And so that Coinbase kind of stands out as the most interesting thing. All right. The OPEX list, spotgamma.com/OPEX. You can please go and check that out, and you'll be able to get that download. All right. That is going to wrap it up for us today. As we kind of come up the top of the hour, I know a lot of you are looking forward to FOMC, and so there will be a lot shifting there. Again, if you are a SpotGamma subscriber, thank you so much. We really appreciate it. We hope we're delivering the value, so to speak. And if you are not a SpotGamma member, how dare you? Go over to spotgamma.com, go to get started, sign up for Alpha. Alpha gets you all of the best tools. So if you're going to take the discount on a longer term plan, when you do your annual sign up, you get a better deal there, obviously, but then you're getting Trace and Hero and all the other things that we have in the platform. And again, over these next couple of weeks, I think next 2 weeks, really, it'll really It should hopefully pay for itself. I'll leave it at that. No guarantees, obviously, but the options flows I think will be particularly impactful. So go and check that out. If you have any other questions, info@spotgamma.com. Please go to spotgamma.substack.com to join up there. I've just been posting some longer form pieces out. What else? SpotGamma on Twitter and spotgamma.com/OPEX if you want to get that sheet. How long do an expiration do I find short dated? Generally, it's the next expiration. Cousin Vinny, thank you so much for the kind things. JT says if Yo hits, he'll sign up. Love to hear it. And all right, that's it. Okay, I'm really done this time. I know I said that's it for about 10 times. Thank you all for joining. Thank you all so much for joining us today. For members, I'll be back on Monday for the regular scheduled Q&A. And then we have the JP Morgan collar trade coming up for the end of the month. So lots of stuff to talk about this week and next. Again, any questions, info@spotgamma.com. Appreciate y'all listening to me very much. And we'll see you soon. Good luck today.